Welcome to the Southbank Weekly Bulletin. I thought I would kick off with the Bank of England's balance sheet. So it peaked right at the end of 2021. And that peak was a very significant move because it more than doubled the size of the Bank of England's balance sheet from the low in 2020. So that was a huge just injection of new liquidity into the UK economy. And what it helped to do was to preserve economic growth, but it also kicked off inflation. And since then, they've been attempting to reduce the size of the balance sheet. So it has come down from about 1.347 trillion to about 1.086. So that's a reduction of about 300 billion out of the Bank of England's balance sheet, which is not an inconsiderable sum. But I think one of the important things here is that during the pension crisis between September and the end of the year, they injected quite a lot of money, going from about $1 trillion and change up to 1.16, so 160 billion of assistance for the pension system to ensure liquidity. And as soon as the immediate effects or ill effects of that pension crisis had unfolded, they got right back to reducing the size of the balance sheet. Now, the thing that I want to pay particular attention to is that, generally speaking, when we get asset price appreciation, that is usually accompanied by quantitative easing. That has been the lesson of the last decade. Whenever the bank is, whenever any central bank around the world is massively inflating the size of its balance sheet, it contributes to asset price appreciation. So stocks, bonds, and property prices go up. But what people don't generally tend to think about is what happens when the central bank balance sheet goes in the opposite direction. Well, when we have had those periods where they've been reducing the size of the balance sheet, we've generally then seen deflationary forces taking hold. And that's basically what we're seeing now. Stock prices have been mostly range bound. Then we've seen that the bond yield has popped on the upside, but it is now stabilizing. And we're seeing some weakness coming into property prices, and not least because interest rates are higher than they have been in really quite a long time already. So now, as we look at the size of the Bank of England's balance sheet, it's contracting, and that is quite likely to contribute to some of the deflationary issues that come or in tandem with fears of a recession. So, with that in mind, let's just pay attention to what's happening in terms of some of those stock markets. So the FTSE 250 is steady, but right now testing the region of the upper side of the range from the perspective of a foreign investor. If we look at this in local currency terms, then it's also testing the upper side of the range. So not quite in the region of the peak from back in February, but testing the upper side of the most recent range. Then let's look at the FTSE 100. So this is a more internationally oriented index with much larger cap blue chip type companies, and it has also rebounded in an impressive fashion over the last 3 weeks. It probably needs a weaker pound in order to push it up through the 8,000 level, and failing that, a substantial improvement in global economic growth. Now, what we had over just the last 24 hours was Rishi Sunak basically coming in support of North Sea oil. And I think this is about time. I've been laboring this point for as long as I've been writing for Southbank Investment Research. The UK was an energy exporter, and there was money for everything, and standards of living were high, and you had a much more content population. And then the UK stopped exporting because oil in the North Sea basically went dry. And at the same time, there was a lot more enthusiasm for renewable energy. Well, that didn't deliver the same kind of energy independence security that the UK had in the past. And a lot of the challenges that the UK have faced over the course of the last decade has been because of a shortage of cash. And that was particularly true in the aftermath of the global financial crisis. Well, being an energy independent nation is certainly something that helps with not having deficits and being less dependent on imports. Oil prices are also now breaking the downtrend. So when we think about inflation, well, a lot of the inflationary pressures that have been sensitive to interest rates have already been dealt with. It's the bits of the inflation curve that are not sensitive to interest rates have been a bit more sticky. But we've also had a significant decline in commodity prices, particularly energy, over the last year. And that's been one of the leading causes of inflation starting to come back down. Well, it's a good news, bad news story. If oil prices rise from here, well, then that's going to stoke inflationary pressures. It's going to make the cost of living crisis worse. It will also hasten a recession. And surging energy prices are one of the leading causes of recessions. So we would certainly have to pay attention to that. But of course, what it's also going to do is stoke interest in energy assets. And we've seen that a large number of energy companies have actually been quite weak and are at least steady over the last 6 months because investors were worried that they would not be able to repeat the outsized profits that they put in 2021 and early 2022. And of course, if oil prices do rally from here, well, then the profit outlook for those energy companies is going to look a lot rosier, and there'll be a re-rating of those shares. So, like I said, a good news versus bad news story overall. Then I think it's also particularly relevant right now that the uranium miners are starting to appreciate. And this is also a response to what we might term an energy crisis. The one thing that we know for certain is that it gets hot in the summer. And if people are going to enjoy a better standard of living, then they're going to need air conditioning. And air conditioning is exceptionally energy intensive. And I can tell you that during the summer, when the average temperature rises from about 25 degrees to 40 degrees in my home, well, for that 2 months in the summer, our energy bill doubles in order to try and keep the temperature in the house down to about 23 to 24 degrees. So that means there's going to have to be a massive jump in energy supply. And that is before we even begin to think about the demand for electric vehicles. There's been there's been the threat of electricity blackouts. I spent the last week in Ireland, and where my sister is living in North Dublin is experiencing blackouts about once a week at the moment because of the demand for electricity. And there's simply not enough electricity for the volume of housing that is getting built in the north area of Dublin. Now, if you start thinking about the requirement for electric vehicles when the electricity grid is already under pressure, then there's going to have to be an acute demand or a supply response in response to that demand. And uranium is one of the easy ways to get that done in a zero carbon environment. So the index is steadying from the current region. What it also helps to tell us is that there are investment opportunities, even in an environment where the US market is very overvalued, where we have the NASDAQ 100 in the region of its all-time peak, and where the concentration of performance in just the 7 largest companies is now greater than it was at the all-time peak back in 2021 and early 2022. So this is this has been an incredible advance over the last 6 months. It has completely recouped the decline in 2022 and improved upon it. But it means that the performance in the market has been driven by a very small number of shares, and that isn't sustainable beyond the short term. So I would much rather look for value opportunities than chase accelerated trends in the current environment. And I think with that, I'll leave you for this week, and I'll wish all the best to all of you.